Howdy, Jacob here. Today we're looking at Texas Instruments. The company is in the semiconductor and equipment industry. 154 billion market cap, 156 billion enterprise value, a little bit of net debt. Huge return on invested capital historically, though. It looks like in the last 10 years, the lowest year of return on invested capital is 18%, getting as high as 41%, averaging in the mid 20s, which is a very great return on investment. That does get inflated, though. Keep in mind if you buy back shares. So if this company has been buying back shares for quite a while, that could inflate this number, and they've been incorporated since 1930. So that could be the factor here. A little bit of growth, not as immense as some other companies we've seen in this high ROIC screener, but you can still get fantastic investments through small growth companies, even no growth companies, because everything is the price you pay for it. So if a company is declining from a billion in revenue to 100 million over the next 10 years, and you buy it for $1 billion, you can calculate what that math would be. But you can still have a great investment on a smaller growth company, and so increase on margins, both operating and gross margin, very impressive. So we're looking at a lot of positive things here. Balance sheet shows about 8.5 billion in cash-like products, 10 billion in long-term liabilities, 11 billion plus the short-term. Not a big concern. That's about a net of 3 or 4 billion, and their 5-year average is probably around 5 or 6, probably 5 billion. So definitely no concern on the balance sheet. They have been reinvesting quite a bit back into themselves, which you can see through their capital expenditures increasing very substantially. Capital expenditures, or in the property, plant, equipment line for most companies in their free cash flow statement, you see what it takes to keep the business going, and then there's also reinvesting into, like you see, property, plant, equipment to incur growth and everything. Their use of cash is pretty much outside of reinvestment, a little bit of share repurchases, and their dividend is paying out quite a bit of their free cash flow, a very large amount actually. It looks like 4.5 billion in aggregate, and we said the 5-year average free cash flow is probably about 5 billion. So a little bit concerning there. I would want them to cut that dividend. I mean, it's currently 3% yield. That's pretty solid, but you have to understand that they're using that cash from free cash flow. And so if their free cash flow gets hindered, the only things that they can do to fund that dividend is the same if it's the company's losing money. You can either issue shares or issue debt. And so you want a company's payout on the dividend. It really depends on how old the company is and where they are in the growth stage. But a more mature company like this, founded in 1930, I feel like a very solid dividend would probably be anything under 70% on a 5-year average basis. And so it is still very substantial based on that. So I would be a little bit concerned with them keeping their dividend where it's at. I think they could keep it where it's at. It's just the use of cash flow to reinvest in yourself, buy back shares that are stupidly cheap. You want money left around to still be able to do that, even for a very mature company, since mature companies can still go very cheap at times, and you want them to be able to reinvest back into themselves to get that maybe 12, 15% return that you just can't get through. You normally don't get through just paying out the dividend. And so let's start making some assumptions here. I think on the revenue side, I'll probably be looking at. I mean, this. I know the semiconductor industry is going to grow like crazy, but I don't know. This company's pretty old, and that's also there's going to be new people joining, new companies joining the industry, and so they might have a little smaller growth ahead of them. Maybe let's do 4%. However, I think that people have heard of Texas Instruments. I don't think that it's going out anytime soon, and we still see that both margins are expanding, which is a great sign of a moat. So maybe let's put on a 16p, slightly above the market, saying at the end of 7 years it might be maybe with the market a little bit higher than market average due to the fact that they have ability to reinvest back in themselves if they so choose. but the company does pay a very large portion of their free cash flow in a dividend, which is not reinvesting back in yourself and something you wouldn't necessarily give a premium on. And then for margins, I don't like that free cash flow is lower, but if you just take out the last year, they're relatively similar, so that's fine with me. Okay, let's do 40, 37, and then repurchasing of shares. 0.5% would be, so 1.5, 750 million. I think that seems pretty reasonable to me. So let's say what I did there is just for an approximation on share repurchases, I looked at their market cap. I saw what 1% would cost them. It'd be about 1.5 billion. I looked at what they've done historically, and they've done as high as 3.4 billion or 4.7 billion. But I would say I wouldn't be surprised, including their stock-based compensation, it averages about that 750 million in aggregate, which would be about 0.5% of shares. And then for their dividend, it's very high. I don't want them to cut it, but I'm going to say keep it the same. Keep the rest of their cash flow to growing that business, increasing efficiencies, so increasing margins, and then maybe buying back shares when they get stupendously cheap. I think this isn't perfect capital allocation, but you have to understand when you make assumptions, you have to balance out what you want the company to do with what they've done historically. And we see that they've been increasing that dividend very substantially, double digit every year, except for just this last year. And so I don't see them taking away the dividend anytime soon. They're not going to cut it or anything unless they really have to. And so what I did there is say that there's less money to reinvest back into yourself. There's less money to buy back shares. But through all their capital allocation, I think that this is a very appropriate. These are very appropriate assumptions, and we get to a price that needs to fall over 50% before you get a 50% return with these assumptions. I think that these are fair assumptions. I think I just think it's a bit expensive at these prices, but I hope you enjoy the video and have a great rest of your day.